Welcome to The Explainer. Today, we're tearing right into Occidental Petroleum's Q1 2026 earnings report. Now, if you track the energy sector, you already know Oxy has been under a microscope for years. But this latest data, it shows a dramatically leaner machine. We're going to focus on their massive debt reduction strategy and a major shift that literally altered the trajectory of the entire company.
So, you might be wondering, how exactly do you erase $10 billion in debt overnight? Well, to understand that, we have to rewind to the massive debt burden from the 2019 Anadarko acquisition. It was a bold move, sure, but man, it left them with a financially punishing balance sheet. For years, that debt was just this dark cloud hanging over everything Occidental did. It made investors jumpy, and it severely limited their flexibility. The big question was always, how do you escape that kind of crushing weight without completely wrecking your core operations?
The answer is right here, $13.3 billion. That is the principal debt remaining today. And to put that into perspective, it's a massive victory compared to the staggering $23 billion debt load they were carrying at the start of 2025. Just let that sink in for a second. In a really short window, they've hacked away nearly half of that terrifying peak debt. They didn't just trim the fat, they completely reshaped their financial foundation. And get this, management has already set their sights on a $10 billion principal debt milestone next.
Section 1. The OxyChem Catalyst, a $10 billion move. So, how did they actually execute this turnaround and buy their financial freedom?
Because, let's be real, you don't just find $10 billion in the couch cushions. It required a very deliberate strategic play. The contrast here is wild between the burdened balance sheet prior to the roughly $10 billion sale of OxyChem to Berkshire Hathaway versus the immediate $7.1 billion debt paydown that followed right up through early May. By carving out and selling the chemicals business, management successfully reallocated their capital. They traded a massive asset for instant financial flexibility.
Moving to Section 2. Smashing Q1 expectations. Let's look at the actual numbers and see how shedding that weight translated into an absolute blowout quarter.
Having less debt is fantastic, but what you do with that newly freed up cash flow is what actually drives the business forward. The crucial takeaway here is that they didn't just meet Wall Street's expectations, they absolutely crushed them by nearly 80%. Analysts were projecting an adjusted earnings per share of 59 cents, Occidental delivered $1.06. This incredible performance generated a massive $1.7 billion in free cash flow from continuing operations. That is a 52% year-over-year jump. When your earnings move like that, believe me, the market pays attention.
And the track record proves Q1 wasn't just some lucky fluke. For 5 straight quarters, they have consistently beaten consensus EBITDA estimates, which measures their core operational profitability, by 7 to 23%. Even when realized crude prices were softer in previous quarters, Occidental's management found ways to squeeze more value out of their portfolio than Wall Street projected. They are consistently proving the analysts wrong simply by running a tighter ship.
Production is humming along too. They surpassed the high end of their guidance, hitting 1,426,000 barrels of oil equivalent per day. That growth is up across the board, driven by really strong operational performances in the Permian, the Rockies, and the Gulf of America. They're literally pumping top-tier results out of their highest quality assets, ensuring revenue stays robust while they execute this massive corporate transition.
Next up, Section 3. Under the hood, driving operational efficiency. Producing more oil is great, but that's only half the battle.
In the energy sector, if you can't control your costs, price fluctuations will eventually eat you alive. Occidental is targeting another $500 million in cost savings this year, splitting that between $300 million in capital and $200 million in operating and transportation costs. Because of this relentless focus, they've dropped domestic operating expenses to just $7.77 per barrel of oil equivalent. That's their lowest quarterly domestic OPEX since 2021. Add in 7% lower well costs and 5% less facility costs, and they are quite literally doing more with less.
And here is why this is absolutely crucial. While 84% of Oxy's resource base breaks even at $50, their average resource break-even is an astonishingly low $38 a barrel. That creates a massive operational moat. It's the magic number. It means even if global oil markets throw a tantrum and prices plummet, Occidental has built a fortress around its cash flow. They can comfortably weather storms that would severely wound competitors carrying higher overhead.
Section 4. Rewarding the shareholders. Let's talk about the ultimate payoff of this multi-year transformation.
When you run a leaner, more efficient operation with significantly less debt, the financial benefits flow straight to the investors. By aggressively paying down that principal debt, Oxy expects to realize approximately $365 million in pure interest savings in 2026 alone compared to 2025. That is $365 million that is no longer being handed over to banks just to service debt. It's newly liberated cash staying right inside the company's ecosystem.
What you should really take away from this is how quickly they rewarded shareholders. They used those savings to fund an 8.3% dividend hike, bringing it to 26 cents per share. Over the last 4 years, they've roughly doubled that quarterly payout. It is a crystal clear signal from management: the emergency phase is over, the balance sheet is fixed, and it is time to return value to the people holding the stock. Finally, Section 5, the horizon, what comes next? Moving from the present to the future, the company's undergoing a major leadership transition just as they hit their financial stride.
Departing CEO Vicki Hollub essentially drops the mic with this statement. Stepping down in June, she is handing incoming CEO Richard Jackson the healthiest balance sheet the company has seen in years. She took a lot of heat for the Anadarko acquisition back in 2019, but she is leaving behind a highly streamlined, cash-generating portfolio. Jackson inherits a company that no longer needs transformative acquisitions, it just needs disciplined execution.
Let's see how this builds through 2026. They plan to reduce capital spending to between $5.5 and $5.9 billion, which is a $550 million reduction, while still aiming to grow production to 1.45 million barrels a day. Just let that math settle in. They are spending $500 million less, yet expecting to produce more oil. It's the ultimate testament to the structural efficiencies they've built into their drilling and completion programs.
We leave you with this final thought. Knowing Oxy can generate massive free cash flow even if oil prices plummet to that $38 break-even floor, how high could this transformed company climb when the cycle turns in their favor? They've completely rewritten their financial DNA, and the heavy lifting is done. Thanks for joining us for this explainer, and we'll see you next time as we continue to break down the strategies shaping the markets.